We're in conversation now with Indian Hotels MD and CEO Puneet Chhatwal. Company in the news after they've announced acquisition of controlling stake in two hospitality firms, ANK Hotels Private Limited that runs the Clarks line of hotels, and of course Pride Hospitality. The combined acquisition size is about 204 crores. Mr. Puneet Chhatwal now with us. Thank you so much for speaking with us, Mr. Chhatwal, and always a pleasure to have you with us here on NDTV Profit. It's an interesting set of acquisitions. You've clearly been on a shopping spree. Tell us the rationale.
The rationale is in line with what we have been guiding under Accelerate 2030 of the growth coming mainly from our mid-market segment with Ginger and an upscale with gateway brands, keeping Taj as pure as possible, keeping Taj as the crown jewel, yet stimulating the progress, addressing India's mid-market needs, and also making Ginger the strongest mid-market brand in the next 12 to 18 months with 250 plus hotels.
So the mid-market focus, talk us through a little more on that, Mr. Chhatwal, and how do these two acquisition targets add to the brand overall, and how do they sink in with your broader perspective?
Well, there is a need that we are trying to address because given the population of India, the majority of the play at the moment and going forward will be in the mid-market in terms of scale. Your profitability and revenue still might be the highest coming from upper upscale and luxury segments, but this is a segment that needed to be addressed. There was hardly any branded supply in this segment. And I think many years ago, we started the Ginger brand, which we reimagined in 2018 and 2019, and made it more into a lean, and needed kind of accommodation which provided the best value and yet gave you a wonderful experience. The profitability of Ginger has been increasing by leaps and bounds. The revenue started increasing, and today we are getting close to almost 10% of the total reported revenue of the hotel segment of the company coming from just Ginger, with very high EBITDA, which used to be 5-7 years ago the revenue of the Ginger brand. So I think all in all, Ginger is expected to contribute 15% of the total revenue going forward, and at the same time address the needs and wants of the middle class in India that needs clean, affordable accommodation in tier 2, tier 3 markets, spiritual destinations, including in the metros. And our success of Ginger Mumbai Airport is definitely a very good proof of all that.
So just on these two acquisitions specifically, Mr. Chhatwal, in terms of their turnover, I think about 14.32 crore for ANK, if I'm not mistaken, and about 19 crore odd for Pride. The valuations at which these have been acquired, there are some analysts who are questioning those valuations, even though the long-term revenue accretion is very clear. What is it that you can add on this perspective and how we've arrived at these valuations?
You see, I think it would be fair to say that in the last 20 years, we reached only 70 hotels in operation and another 35 under development with Ginger brand. This gives you a doubling of the scale in the same time. It's not always about the valuation based on what it is today. Our experience is the upgrade to the Ginger brand with the look and feel of Ginger brand increases the revenue by 30%. And these revenue numbers look low because they are totally on asset light model, which means this is the income through the management contracts that these two companies have. And I think given our current model and the complementary model of capital light, it provides Ginger with a very well-hedged portfolio. And we have an analyst call this evening in which we will be able to explain that better to the analysts.
Okay, fair enough. What is the kind of expenses or capex will be required to bring all of these hotels up to the mark? What are the investments that you envision going forward, or are they all, fairly close to ready to use?
They are ready to use, but not as a ginger. So it will be a journey which will last, let's say, another 12-month period after the completion of the acquisition. Some may need only a few months. Some may need 8 to 10 months. Some may need, 12 to 14 months for the proper conversion to the brand. And what we call as a property improvement plan, which will be made for each of these properties. And we have funds available of our own in the company, but also because it's a different kind of a model, some owners would want to upgrade, and might be an opportune moment for them to upgrade the asset, embracing the key elements of the Ginger brand. So all in all, I think it would be fair to say that anything between 1 to 2 crores per hotel in operation is the minimum amount that will be needed to upgrade to Ginger level.
Okay, and you talked about Ginger now contributing to 10% of revenue with all of these additions coming on. I believe all of this starts happening from November. What is the total revenue portfolio of a Ginger, or this side of, mid-sized, mid-luxury hotels that you see to the overall picture?
See, post completion of the acquisition, if we took rolling 12 months looking forward, we're looking at more than 1,000 crores of revenue just coming from the Ginger brand. And the whole complementary value proposition through the cumin all-day diner at Ginger, it has made it a very compelling proposition. And we, as I mentioned earlier, we've seen a lot of traction and a lot of growth in the same property, same asset, by insourcing the food and beverage under the cumin brand, and adding the reimagined Ginger key elements of the brand to the property, which give you the uplift in the average room rates.
So, in the next 3 years, what is the revenue contribution that you're seeing, Mr. Chhatwal?
Our aim for Ginger's contribution to the revenue would be 15%.
Okay, over the next 3 years, of course. Now, in terms of the model that you were talking about, you mentioned a little earlier that some of the owners would also be encouraged to upgrade because of the kind of model this is. Could you shed a little more light on that, on what exactly is this kind of model?
This is, these are spaces when you enter into a lobby, very vibrant with, very interactive kind of spaces, strong Wi-Fi, a lot of music, also playrooms in the lobby, whether you want to play table soccer or have other fun elements in there. And of course, all the colors, it's very vibrant colors that we use, and that's why a lot of painting will be needed in this entire acquisition of the portfolio, so that it looks and feels very vibrant.
No, I mean, sir, may I just rephrase my question? What I mean to ask is, what is the owner's contribution? You have 51% acquisition. What will be the role of the owners? If any, is there a profit share there? Because you mentioned a model earlier, so this is what I was pressing on.
You mean the individual owners,
yes,
or the company?
Yes.
The individual owners, they benefit from the P&L and the profitability of the property. For us, only the amount of management fee, because the revenue should increase, will go up. But all in all, it creates a win-win situation, as we would only get a small percentage of the total revenue, because that's how the management contracts work. In that kind of a model, the larger upside sits with the owners. And that is what makes us believe will make owners very happy to embrace the Ginger brand without any kind of hard selling needed from our side.
And your acquisition at 51%, does this now increase over time, or you want to stick to this 51% of what you now own in these two companies, or you will own?
We are very pleased with what we have today. Should that change, I'll share with you, Tamanna, first.
Okay, so while I have you here, sir, and of course we're speaking about these acquisitions, let me get a sort of a temperature check of what is happening in your space. Q1 across the industry, I think, has surprised on the upside. People thought that there would be a lot of stress with what was happening in the region, geopolitically, etc., and with consumption overall. That doesn't seem to have panned out. Do you see that trend continuing?
I've always been very optimistic. I think it's the beginning of a very long cycle for the hospitality sector, and I'm not talking about a few quarters. I'm talking about a broader view over the next few decades. This is the sector that comes in last, and just like there has been a evolution, let's say, of the automotive sector from CVs to EVs. I think this is the era of hospitality, aviation, tourism over the next few decades. So there'll be headwinds every now and then, things beyond anybody's reasonable control. But overall, demand will outpace supply. And overall, the demand will continue to increase as India keeps track on its GDP growth journey of 6.5 or higher, creating higher disposable income and more people wanting to travel and experience more, either for business or for leisure needs.
Have you been seeing any kind of a drop in demand at the higher end, at the luxury end of the portfolio?
Not really. I think there is, it would be fair to say, following the unfortunate incident in Pahalgam and then Operation Sindoor and then the airline accident and the unrest in the Middle East geopolitical tension, Iran and Israel, there was a temporary drop. But as I look at it now, April more than compensated for May and June. Similarly, August, the way it is going, and September, the way the business on the books is expected to compensate very strongly for a sluggish July.
All right, and there you go. That was the management of IHCL talking about the rationale behind their newest acquisitions, in fact.